Hi folks, welcome back to our second video on this problem, and we're going to focus now on calculating non-controlling interest at the end of the current year so that we can put that on our balance sheet. Now don't forget, your textbooks suggest that there are two ways you can do this. The way that I normally do it is because I calculate using this first method here, but I've done both just in case somebody wants to use the second method. The more common method for me anyway is to calculate non-controlling interest based on the ending book value of the sub. Now why do we do that? Because don't forget, NCI shareholders are shareholders of the sub. In our case, they only own 25% of the sub's equity. Well, the sub's equity right now is sitting in common shares and retained earnings, plus their share of any acquisition differential. Those are the unamortized fair value increments and decrements that were assessed by the parent. NCI gets its cut of that as well. So the first method we would normally use is we would say, well, we can calculate the common shares and retained earnings, the ending book value of the sub, on the date at which we want to calculate NCI. From the question, they tell us the common shares and retained earnings are as we have them here, for a total of 2.6 million. We know that we have an unamortized acquisition differential if we go back up here to our schedule, right? Of 480,000. We got this from the question when we did the first part of the video earlier. So I'm going to use that. In total, that's 3,080,000. NCI shares 25% of that. So I'm going to get ending balance of NCI in the consolidated balance sheet of 770. Some people may prefer to use the other method, so I'll review it quickly here. You might prefer to start with the opening balance of NCI because it is a balance sheet account at the date the two became related. And then how does NCI change? NCI changes in our case as a result of any post-acquisition adjusted retained earnings of the sub, and the NCI would get its share of those post-acquisition adjusted retained earnings of the sub. So just as we calculated up here when we were calculating the post-acquisition retained earnings of the sub and allocating 75% of it to the parent, what we're going to do here is we're going to calculate for the NCI, the post-acquisition retained earnings of the sub, all right, at this date. Now you're going to notice, you're going to say, well, this says here negative 240, but I'm getting like here negative 120. Well, don't forget, the difference is that I'm calculating the adjusted post-acquisition adjusted retained earnings of the sub at January 1, year 6. This part of the question, NCI is getting its share of the post-acquisition retained earnings of the sub at the end of year 6 because NCI is being calculated at the end of the year for the balance sheet. So I'm going to have the post-acquisition retained earnings of the sub at 600,000, just as because my retained earnings at the end of year 6 for the sub is $1 million, right? Notice here, when I was using it here, it was 800,000, but that's at January 1, so that doesn't count, right? It doesn't count in this calculation because I'm at the end of year 6. Here we are at the beginning of year 6. So I'm taking the retained earnings of the sub at the end of year 6, deducting the retained earnings of the sub at the date we became related, because we're only interested now in the 600,000, which is post-acquisition, but we're going to adjust it for the cumulative acquisition differential as at that date. So how much is amortized? Well, don't forget, you had 640 here until the end of year 5, but now you've got an additional 80 at the end of year 6, right? So now in total at the end of year 6, the cumulative acquisition differential plus impairment losses is 390 plus 250, which was 640, but now I got that additional 80. So I'm going to include it here to get negative 720. So now 600 less 720 is going to give me $120,000 deficit. NCI now gets its cut, which is 25% of that deficit. So I'm going to get 770,000. So you can see again, I get the same answer regardless of method. Which method you use is up to you. I strongly recommend that you know both. Both are required to be known for our course. All right. So now we've already done the income statement. So let's focus here. What we've done here is we've done a statement of retained earnings consolidated. Now, normally you don't have to do it if you're IFRS, but the question doesn't tell us whether it's an IFRS-based company or if it's reporting under ASPE. But I just do this all the time just so that I can use my opening balance of consolidated retained earnings to help me get ending retained earnings consolidated, because I got to do a consolidated balance sheet. So you can calculate it this way, and I've given you another way here if you chose not to do a consolidated statement of retained earnings, or if you weren't asked to and you didn't want to use this way, but you just want to calculate an ending balance of retained earnings. All right, so we're going to do it both ways. But if you decided to use your opening balance of consolidated retained earnings, which is what we calculated up here, right, 2.72 million, right, we did that in the first video. What we're going to do is we're going to use that as our opening here. Now don't forget, retained earnings is adjusted based on the parent's income. Well, don't forget, because we're doing consolidated statements, those are the parent statements to its outside users of statements, right? Don't forget, we only pick up the part of consolidated net income that's attributed to the parent. And we did this calculation of attribution when we did very early on the calculation of consolidated net income. This is what we did up here, right? So we only take the parent's share of that, right, which is 1,090,000. So we update it for 3.81 million, and these are the dividends that are declared to the parent shareholders. It's got nothing to do with the sub-shareholders, because consolidated statements are prepared for the parent shareholder. So we deduct the dividends declared to the parent shareholder, and that's going to give us 3.31 million as our ending balance of consolidated retained earnings. The other way you could do it, if you didn't want to calculate the opening balance, or if you didn't need to for any reason, you could start with the parent's ending retained earnings balance at should have been 12/31 year 6, which from our question is 3.4 million. Then what we can do is we can look at the subs retained earnings at the same date, take the post-acquisition amount of the subs retained earnings and adjust it for the cumulative acquisition differential up to and including the end of year 6. So all we're saying here is that the ending balance of consolidated retained earnings is P's, separate entity retained earnings, plus the subs adjusted post-acquisition retained earnings at the parent share. Because these are consolidated statements, the parent's preparing it, it only wants to pick up its share, which is 75%. So you'll recall we did this calculation up here, right? We were calculating NCI using method 2, right? We kind of did that calculation. So we're picking up this number here, right? Now, don't forget, because we're doing consolidated retained earnings, we're only looking at the retained earnings that the parent is picking up from the sub. That means only its share. NCI picked up 25% when we calculated NCI on the balance sheet, but now the other 75% gets allocated to the parent through its retained earnings, and that happens to be a negative or a decrement, which is 90,000. So again, we're going to get 3.31 million. 3.4 million of the parents plus the negative 90,000, which is 3.31 million. So either way should give you the right numbers. Now, the next thing we're going to do is we're going to use the NCI and the retained earnings in order to calculate or to prepare the consolidated balance sheet. Okay, so now if we have a look at the consolidated balance sheet, we're going to take the cash of the parent and add it to the cash of the sub, right? Which is going to give us 400,000, right? The accounts receivable, to get your accounts receivable, you'll notice that we deducted 75,000. The reason we did that was because we noticed that silver didn't have any receivables at the end of the year, right? But the question, so it's like a plus 0 here. But we had to deduct 75,000 because 75,000 of that 200,000 is intercompany. The question told you that the sub owed the parent $75,000 on December 31st, year 6. Well, what that means is that's an intercompany payable and receivable. And in our chapter, they indicate to you that because it's intercompany, it's not a receivable and a payable that's generated with an outside third party. And we've said before that we're only interested in amounts to show up on those statements that are related to outside transactions. So therefore, what we need to do is eliminate it from the receivable, and you will have noticed here in the liability section we removed it from the liability balance of the sub. All right, so we remove this from the receivable balance of the parent, and we remove this from the liability balance of the sub, and we'll get $125,000 in here, and our liabilities at $1.125 million. Now the inventory, don't forget, we no longer have the increment in the inventory. That was assessed at July 31st year 2 or July 1st year 2, and that's been amortized because inventory is a current asset, so it no longer exists. So we're just going to take the inventory of the parent and add it to the sub to get $2.42 million. Now we have to, and you can see here we've got goodwill. I'm just going to skip the plant and equipment and its accumulated depreciation for now. I'm going to hop to goodwill, because where do we get this number? Don't forget, it should be sitting in that schedule you did a while ago, which is your amortization schedule and impairment loss schedule. And you'll see here that the balance of your goodwill after the impairment losses have been taken into account are $270,000. So you can see that this schedule is used for a whole lot of things. To calculate your cumulative acquisition differential to the end of any period, to calculate your current adjustment to net income of the sub, to calculate consolidated net income. This piece gets allocated in part to NCI at 25%, and you're going to need this number here to put in your consolidated balance sheet. So this has a lot of very valuable information in it, so you do need to know how to do this and do it correctly. All right, so now we've got that, okay, on the balance sheet, way down here, right? And now let's go look at the plant and equipment and accumulated depreciation. You'll notice here that we include the increment and we deduct from that increment the $60,000. In fact, we're deducting $60,000 here and $60,000 here. Why? Because that's as a result of accumulated depreciation, all right, that was sitting on the sub's books. So let's deal with the $60,000 and then we'll deal with the increment. Here's the deal. Whenever you get a question where they have accumulated depreciation as a separate account balance, because many of these questions are looking at plant and equipment at net, so they're not netting out any accumulated depreciation. So you never had to deal with it before. But in some of the questions, they include accumulated depreciation. So what do? First of all, any accumulated depreciation that the sub had booked is irrelevant to the parent company. Why? Because the parent company is picking up fair value. Remember, under the acquisition method of preparing consolidated statements, you're picking up the carrying value of the sub, right? Plus the fair value increments. So you're picking up fair value of what you think the sub those assets and liabilities are worth, right? So if you really think about it, any of that accumulated depreciation you're not picking up, right? So this writes off the accumulated depreciation basically directly to the plant and equipment, so that it shows the plant and equipment at net. So it's kind of like whatever the plant and equipment was valued at the date the two became related, we deduct the $60,000 from that because we're not picking it up. If you wanted to think of it in this area and this area here in terms of an eliminating entry at acquisition, you could think of it this way. The acquisition eliminating entry at acquisition date. Remember, we did the acquisition eliminating entries before. They are in the appendix of your text. I don't require that you need to do them if you're not asked to do them, but you have to consider that that piece. If you were doing them, you would basically be doing what? Getting rid of the accumulated depreciation at $60,000 and you would be crediting your plant and equipment for $60,000 so that you're picking it up at its carrying value, right? And that's what they're doing. They're reducing the accumulated depreciation as well as the plant and equipment itself to show the plant and equipment at its carrying value at the date you would have picked it up, right? Now, obviously, since they became related, right, there may have been more plant and equipment purchases. I don't know. I don't know what that value was at acquisition. We don't know. But we do know that to facilitate the consolidation, if we're not picking it up, we would actually write it off. And they do some discussion of this in the appendix and as well throughout the chapter earlier in this chapter. So now the idea is if you're not picking up the accumulated depreciation, because they've separated out plant and equipment and accumulated depreciation, you've got this 480 here and you've got this 270 here. Well, what are those numbers? Well, don't forget, this is the fair value increment and what you've amortized of that increment so far to the end of year 6. Because we know that the plant and equipment at net, its unamortized balance is 210. 480 less 270. How do we know? Well, you got it up here. You did it. You did it up here. Here it is right here in this line. You said that the fair value increment on the plant and equipment at net was 480, right? We calculated that up here because they told you that 40% of the acquisition differential goes to equipment. And we've been amortizing it. All the way to the end of year 6, we amortized 270, and that gives us a net balance of 210. So anything that we've amortized, in most questions you'll find in the chapter, goes directly to plant and equipment because they give you that number at net in the question on the separate entity statement. However, in our case, they gave us accumulated depreciation. So this is going to adjust your accumulated depreciation upward on the consolidated statements because you assessed an increment, which you as the parent company thinks needs to be amortized, is an increment, so it's an increase in value. So if you think the value is higher, you're going to be depreciating it. The depreciation base is higher by 480, right? And you're going to include that increment because now the plant and equipment is sitting at cost, less accumulated depreciation on the statements. So here what we've got, if you go down here, this is our plant and equipment at cost, which includes the 480, but again, we don't want the 60,000 because that predated the relationship. And again, your accumulated depreciation is going to be increased by 270, which was the 30 plus the 180 for years 3, 4, and 5, plus the 60,000 for the current year. Okay, so I guess the thing is, don't get this 60,000 mixed up with the 60,000 that's in here. This is your fair value increment at net, the 480 less the 270, which is in your schedule of amortization differential, acquisition differential amortization in your impairment loss schedule, right? So now we've got $8,055,000, and again we take the common shares separate entity of the parent, the retained earnings consolidated, which we calculated, and the NCI, which we calculated, and we have a balanced consolidated balance sheet at $8,055,000. In Part B of the question, they ask you to find out goodwill impairment loss and NCI on the consolidated income statement, or they want to know how much would show up on the consolidated income statement at the end for the year ended December 31st, year 6, if we were using the parent company extension theory. Well, we already know if we're using the parent company extension theory, NCI does not get allocated its share of goodwill, so neither does it get allocated its share of goodwill impairment loss. So therefore, we know that the goodwill impairment loss on the entity theory was $20,000 for year 6. How do we know? Well, you had it up here. The question told you, and you put it in there, right? But under the parent company extension theory, NCI doesn't get its share of that. So therefore, I'm going to deduct 25% of that. So if I was doing statements under the parent company extension theory, my consolidated income statement would only show a goodwill impairment loss of $15,000. What would NCI be? So how much would I attribute to NCI? Well, you remember that NCI under the entity theory got attributed 25% of $320,000. How do we know that? Well, when we calculated consolidated net income, we figured out that little puppy right here, right? That's the net income that was attributable to the parent, that should be a calculation of net income, but again, doesn't matter because we attributed down here, right? So therefore, that's 80,000. Well, that includes goodwill. Sure it does, because 320,000, okay, was the entire net income less the acquisition differential amortization, right? So again, that number here includes everything. That's the NCI share of it, right? It's the NCI share for income, right? So therefore, what we would want to do here is we would say, well, look, we're not allocating NCI its share of the goodwill impairment loss. So we're not allocating 5,000 of that, right? Don't forget, the 5,000 is where? Don't forget the impairment loss for the year was 20,000 times 25%, right? So that amount is not going to show up, right? So therefore, NCI under the parent company extension theory would be 85,000, because don't forget, under the entity theory, NCI here has already picked up its share of the impairment loss. How do we know? Because if you calculated consolidated net income up here, as we did, right, we deducted the acquisition differential amortization, which included the impairment of the goodwill, right? So that's in here when we calculate our ending balance of NCI. This 320 includes that impairment loss. If we hadn't included that impairment loss, then the amount that NCI is going to be bigger, right? Because it's not picking up the loss. Here, because NCI picks up its share of goodwill, it also gets allocated its share of the goodwill impairment loss. But under the parent company extension theory, if it doesn't get allocated goodwill, it does not get allocated a loss. And if you don't pick up the loss, your NCI is bigger, right? So therefore, if we go down here, we know that NCI here, under the entity theory, was 80,000, 25% of the adjusted income of the sub, which is adjusted for the impairment loss in part, which is included in that 80,000, but the NCI doesn't pick up its share of that $20,000 loss, right? So we deduct, so it doesn't pick up that share of 5,000. So in essence, NCI under the parent company extension theory is higher. It's higher because NCI doesn't get allocated any part of the loss. Here, this 80,000 included it included the loss, which again is up here, just in case you're missing it, because I know this is a tough concept. Remember, this $80,000 adjustment we made here includes the goodwill impairment loss. Under parent company extension theory, it's not picking up this 20,000. So we say if NCI doesn't get allocated its share of goodwill, it doesn't get allocated its share of the impairment loss. So NCI under PCE is higher. Okay? Now, if we were doing part C of the question, they said to calculate goodwill and NCI in the consolidated balance sheet at the end of year 6 under the parent company extension theory. Well, we know that goodwill, consolidated, we had it up here in the consolidated balance sheet under the entity theory was 270. But don't forget, that includes NCI's share. NCI wouldn't have picked up its share of that at 25%, so it doesn't pick that up. So again, it would be 2025. Now, the other way you might want to think about this, some students might say, well, what I could do here, and you can, is you might turn around and say, well, maybe if I know that the goodwill is 270,000 under the entity theory, oop, I don't want to do it there. If it's 270,000 under the entity theory, then I'm just going to pick up 75% of it, or the parent's share, right? That will also give you 2025. All they've done here is take out the NCI share to show you what's left for the parent, right? Goodwill under the parent company extension theory. Or what you can do is you can calculate it directly, because you already know that under the entity theory, the parent only picks up its share of the goodwill, right? Or sorry, under the parent company extension theory, the parent only picks up its share of the goodwill under the entity theory. So either way will do. You can take it at the full amount and deduct 25%, or just take 75% of this right from the outset. It's okay. I think you might be used to seeing it this way, but it doesn't matter. Whichever way you prefer is fine. Now if we're calculating NCI on the balance sheet, we know that NCI under the entity theory was $770,000. But don't forget, that also includes NCI's share of, it should be goodwill, right? And we already know that they wouldn't pick up their share of goodwill, right? We'll take it out, and that would give you NCI under the parent company extension theory of $702,500, because again the parent would only be picking up its share of NCI, right? So in essence, if you wanted to think of it another way, again, if you wanted to think of it a different way, again, don't forget NCI is not picking up its 25% of this goodwill. So again, if we're not picking it up in the calculation of goodwill, under the entity theory, this $770,000 did include goodwill. NCI does not get allocated its share, so NCI under the parent company extension theory is only $702,500. All right? So this concludes our last video on this topic. So hopefully you found this to be a little bit of help for you in understanding both different theories. And as you can hear, my phone is ringing.